Hey guys, so this is a video where I'll be talking about some theories behind yield curves and bond prices in general. So we did cover chapter 6, which is a lot of mostly about bonds and about valuing bonds, and we did work out some questions in class as to how to simply calculate the price of a bond based on its coupon and based on its par value. Okay, so we also did look at the relationship between the bond price and the interest rate or the yield to maturity, and typically they have an inverse relationship. And we also looked at the fact that long-term bonds are more volatile than shorter-term bonds. Okay, so for a given change in interest rate, long-term the prices of long-term bonds fluctuate a lot more than the price of short-term bonds. Okay? So, and once we did look at that, we wanted to try and figure out the ideas behind why are yield curves. So, what is a yield curve? So why yield curves vary between like why are they flat in some cases, why are they upward sloping, and in some cases they can be downward sloping as well. Okay, so this is the yield curve is where you plot the yield to maturity on the y-axis, and the x-axis is just the maturity, the years to maturity, typically measured in years. Okay, so you could even go lower than 1 year, in 3 months, 6 months, and 9 months. Okay, so this yield curve are primarily determined by two kinds of theories. The first theory is the idea of expectations theory. So this suggests that investors, let's say if it's an upward sloping curve, right? Let's think about this October 29, 2010. Okay, so the short-term 1 year interest rate was around 1%, and the 10-year interest rate was around 3%. Okay, and the 20-year as well was around 3.2%. This tells you that the one, at least expectations theory is one of the theories. The other theory being major theory being liquidity preference theory, and together combined they kind of explain the slope of a yield curve. Okay, so the expectations theory over here tells that if it's an upward sloping yield curve, tells you that investors expect short-term rates to increase. Okay, so they if it's upward sloping, the short-term rates will, in some sense, increase in the future. That's the idea. And a downward sloping curve would mean short-term rates should decrease in the future. So that's the idea behind the expectations theory. In some sense, whether it's because of inflation or any other factor, this is just based on investors' expectations. Okay, the other major theory is the idea of the liquidity preference theory, where most investors prefer to be in the short term. Why do you prefer to be in the short term? Well, you did see that for different changes, if interest rates ever change, the shorter term bond typically tends to be a lot less volatile than the longer term bond. So, given this relationship, why as an investor would you want to be in the longer term bond? And if the yields are somewhat similar, most investors would want to be in the shorter term, the short term maturity. And the only reason an investor would be in the longer term would be if they receive some sort of higher yield on long-term bonds. If they receive a higher yield to maturity on longer-term bonds, some of the investors will accept that extra volatility uh, for the higher yield. But many other investors would rather have lower volatility and lower yields, and this sort of segregates like different clients into different kinds of maturities. So each investor would prefer something more than the other, and the trade-off is like volatility. If you get higher yield, you typically get a little bit higher volatility. If you have lower yield, you'll have lower volatility. If you want lower volatility, you would be willing to accept a lower yield. And this extra return is also termed as liquidity premium or maturity risk premium or even interest rate risk premium. These are some ideas behind. So so far we've talked about the yield curves primarily for countries. For corporations, you would have additional ideas of default risk, right? Governments typically don't go bankrupt for the most part. For most Western developed country economies, they do not go bankrupt if they can print more money or raise taxes to cover debts. Okay, most governments are really, really printing a lot of money. The Bank of Canada, for example, Global Bank of Canada balance sheet, assets and liabilities. we had very low, the Bank of Canada did not print a lot of money, and suddenly over here, just have a huge increase in the amount of treasury bills they're owning. They're owning a lot of money. They own around $100 billion worth of assets right now. And the US government has around $6-7 trillion worth of assets. Okay, so a much bigger country, obviously, they have much bigger printing capacity. If you call. So, and given that we are spending a lot of money, most investors, most people in Canada can also expect their taxes to go up sometime in the future, as do income earners in the United States as well. Okay. So corporations also have the risk of default, and this default spread is typically the difference between the promised yield on the bond and the difference between the government bond and the corporate's bond is the default premium for a corporation. So this default premium is also usually rated by a lot of third-party providers, typically as like S&P, Moody's, DBRS, and you have Fitch. And different countries have their own rating agencies, right? Like there'll be something for India and for China. The Chinese, they are more experts for the local companies over there, whereas the S&P and Moody's are more focused towards American and Canadian consumers, and a little bit of Europe as well. Okay, so typically, let's go with the S&P methodology. The highest rated bond is given a rate of AAA, a rating of AAA, and bonds rated, it goes from AAA, AA plus, AA minus, all the way down triple B, and it keeps going on to like C and D as well. Any bond which is rated triple B minus and above are known as investment grade bonds, and anything below that is known as speculative grade bonds or junk bonds as well. And the spreads between AAA versus Canada bond and triple B versus Canada bond and triple C versus Canada bond, and these spreads themselves provide an idea of where the economy is going and what's the risk in the economy. Okay? During good times, when everything's going well, the spreads between all these bonds narrow, and when risk is higher in the economy, the AAA bonds have a much lower risk premium, whereas the triple B and the junk bonds have a much higher risk premium because they reflect a higher chances of bankruptcy. Okay, so these are some theory behind yield curves. So I also did something else, and I went into the Bank of Canada website, and I got some yield curves. I wanted to show you how these yield curves actually differ. So this blue line is the yield curve right now, as of September 1st, 2020. Okay, so something in terms of short maturity. So the Bank of Canada, you could download their yield curves for various maturities, starting at 3 months all the way down to 30 years. Okay, so it's given as this, and so 0 to 5 year is 0.25 years. Zero coupon bond, 0.25 years. That's what this methodology reflects. And once you plot them in a graph, this blue line, so the lowest you get at 3 months, you get around 20 basis points. So that's the yield right now. Okay, and even if you go all the way up to 10 years, at 10 years, you're getting only 60 basis points. So it's 0.6%. So these are all percentages on your y-axis. I haven't labeled them yet. And the maturity on the x-axis. So at the 10 years, you get around 0.6%, and at 20 years, you're still getting only around 1%. Okay, that's your return on your bond. That's the yield to maturity on it. So I went back to January 2020, and I got their data, and I plotted that. So in January, even a short-term bond, you were still getting 1.6%. And the long-term bond also was around the same 1.6%. So the curve was very flat. In January 2020, and you could go even further, and I ended up getting, this is for I think 2016, September 2016. Let's plot that as well. It's acting up a little slow. Okay, Excel hung up. I'm going to stop the video, but you could try and add more years. Go to the Bank of Canada website, and you could get some of their yield curves, and you could try and plot them um, for 2016 and 2015, and try and see how the yield curve has looked in various different times. That's it for today. All right, bye bye.